Let's break down accounting for receivables. The most common type is an accounts receivable, which is an amount owed by a customer who purchased a product or service from a business. At the time of the sale, the entry requires a debit to accounts receivable and a credit to revenue. When receivables are deemed uncollectible, they are recorded in the accounting system as bad debt expense. Companies follow the prudence principle and report the receivable at a net realizable value. The two methods to account for bad debt expense is the direct write-off and the allowance method. Under the direct write-off method, bad debt expense is recorded when a company determines that a receivable is uncollectible. For example, Ricky buys a $500 bike on credit from Barry, but Barry decides that Ricky won't pay what is due. Barry must write off $500 by crediting accounts receivable and debiting the bad debt expense account. On the other hand, the allowance method uses two journal entries. A company sets up an account called allowance for bad debt, which estimates the amount of receivables deemed to be uncollectible. Bad debt expense is estimated through the percentage of sales, percentage of receivables, or the aging of receivables. For example, Barry determines that 200 of the $500 credit sale is uncollectible. The first entry debits bad debt expense and credits the allowance for bad debt account. Barry then writes off the balance by debiting the allowance account and crediting the accounts receivable account. In summary, the allowance method follows a matching principle and reports a receivable at the net realizable value, but it does require estimating. On the other hand, the direct write-off method is simple and you don't need to estimate bad debt expense. However, it violates the matching principle and is banned under GAAP. Thank you. Happy accounting.